What's up, everyone? It's Caddy with MoneyVest. So in this video, we are going to be talking a little bit about, wait, hold on one second. I'm sorry. Just got to figure this out. There we go. So in this video, we are going to be talking about the recession probabilities. There was a report from Bloomberg that came out earlier this week that was talking about very, very important indicators of a recession and how the NBER, that's the National Bureau of Economic Research, they've got a lag effect with respect to when they actually declare a recession versus when we are actually in one. So I'm going to break that down and talk a little bit about what analysts are also expecting from later in 2023 and early in 2024. So all that is going to be covered in this video. As always, if you enjoy it, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining. And also, the courses, so fundamental technical analysis courses, I don't mention them enough because I do get a lot of questions asking how you can learn about fundamental analysis, technical analysis, options trading. Folks, we do have courses, we do have videos and tutorials. There's over 40, 50, 60 videos that are constantly being updated. These are all for members only. And again, you do get access to Excel spreadsheets and PDFs and cheat sheets, and everything's included with the link down below. So the first three links are the ones that you can pretty much click on and get familiar with what our offerings are. So links are going to be down below. We'd love to have you on board. So this right here was the report. So why US recession is still likely and coming soon. Now, I've talked about recession on the channel before, and a lot of folks that were calling for recession in 2022 and 2023, they were not really pricing in the lag effects with how high interest rates can impact the economy over time. Because you see, the thing is that there's two different things, right? One is a short lag period, or basically let's just call these items, right, that get affected with higher interest rates on a more shorter time frame versus things or items that get affected by higher interest rates over longer time periods. And the shorter are going to be things like the market's reaction, inflation expectations, the bond market, the yield curves, the spreads, right? These are things that get affected by higher interest rates very, very quickly, right? That happens very quickly because markets are very efficient in that sense that they price in all that information almost instantaneously. And that's why we've seen the stock market in expectations of that recession dropped in 2022 because of higher interest rates, right? So we were expecting, okay, there's going to be a recession. Market started selling off. Second, we saw the yield curve turn inverted, right? So we had the inversion of the yield curve. The spread remained negative for several months now. That happened. And then, of course, we've seen the yields in general continue to push higher on the assumption that maybe inflation is going to stay higher. Maybe there is going to be more interest rate hikes in the future. All those expectations got priced in fairly quickly. But what did not move are some of the longer, more real economic indicators such as employment, such as manufacturing payrolls, construction jobs, borrowing cost in the real economy. A lot of those things did not move instantaneously. It takes time. And over the last 12, 14, 16 months, it took us that much time to get to where we are at over 5% to 5.25%. So we have to understand and make that distinction that, okay, there were a lot of things that priced in a recession early on that never really happened. And now the economic sort of impact is going to start to materialize. At least that's what the expectation is. And I have no doubt believing that, because I think towards the end of 2023 and early 2024, it's possible that we start to see a little bit of an increase in unemployment. We're going to get that report today. So we're going to get that report in less than 4 hours. But of course, over the series of next few months, that report is going to be more and more important. And it's the most important leading marker, right? Jobless claims, unemployed persons, unemployed rate, and of course, the JOLTS numbers. All these are very, very important leading indicators of where recession or whether we're going to see a recession, and if so, how severe. Delinquency rates, credit conditions, a lot of these are indicators that are very important from a recession standpoint. So that's exactly what they're talking about in this report. So they mentioned that soft landing calls always precedes recession. And it was actually a very interesting article because it basically mentioned the most likely outcome is that the economy will move forward towards a soft landing. And that was back in Janet Yellen 2007. That's what they mentioned. And I quote, "The most likely outcome is that the economy will move forward towards a soft landing." So said the then San Francisco Fed President Janet Yellen back in October 2007, just 2 months before the Great Recession began. And Yellen wasn't the alone in her optimism. With alarming regularity, soft landing calls peak before hard landing hits. And this right here is a very good indicator of that chart where these are the number of articles, or number of news articles mentioning the word soft landing. And you'll notice that this right here in 1999, we basically saw this number peak all the way up to that level before we actually saw a recession. This was at 1,000. Same thing happened in 2007, 2008. We saw an influx of articles, right? So significant amount of articles and, news pieces and everything talking about soft landing, soft landing, soft landing. Well, guess what? Recession was brutal back in 07, 08. This right here is kind of like an anomaly, but it wasn't as much as what we are witnessing now. So you can see that as of June, July, we are once again back up to over 1,000. And this right here is the amount of articles being written, being talked about with respect to soft landing. Now, this is just one of the many indicators. Of course, it's a more qualitative metric where, the consensus right now very much is towards a soft landing. But in the past, history suggests that every time we hear that, a hard landing hits. So it's a soft landing hope versus a hard landing reality. Right? Something to take note of. This right here is the same chart, just in a different sense. Here's an example that focuses on unemployment, though, a key gauge for economy's health. The Fed's latest forecast, as we learned from the summary economic projections, edged higher from 3.8% in 2023 to 4.1% in 2024. And that's a continuation of that trend. But what if there's a break in that trend, the type of sudden shift that occurs when the economy goes into a dive? Using a model designed to allow for these non-linearities. I'm going to not say that full word. It's kind of hard to say it. But Bloomberg Economics has forecasted not just the most likely path for unemployment rate, but the distribution of the risk around that path. And this right here is the chart that I think is very interesting, with a confidence level of over 95%. So 95% confidence interval that unemployment could actually get up to almost 10% in 2024. So this right here is 2024, and they're expecting the path is going to be more like this for unemployment, with a 95% confidence interval at the moment. So 68% confidence interval is going to be somewhere around here. So in this example, just a little bit over 5%, 6%, 7%. But of course, there's a pretty significant, variability with where unemployment is going to be. And I think with higher interest rates, if we stay higher for longer, that I think is going to be a bigger issue than how high we get to, right? Because if the Federal Reserve gets to, let's say, 6, 7, 8%, and then drops it down to 2% in a recession, that's not going to be as severe as if they get up to 5% or 5.5% and stay there for a very long time. Because see, the thing is, the world has changed from a credit standpoint very, very quickly. Banks have not adapted to our higher interest rates. Consumers have not adapted to our higher interest rates. Everybody's still holding on to a mortgage, fixed rate, 30-year, sitting at under 2%. Banks are still holding on to a significant amount of bonds on their portfolios, held to maturity or available for sale, portfolios at sub 1% interest rates and yields that don't mature for several decades. And as interest rates have gone up, their market values have declined. So the world has not adapted to the increase in interest rates as quickly as we have seen over the last 12, 16 months of over 500 basis points. And the Fed hikes are about to bite hard. Monetary policy, and Milton Friedman famously said, quote, operates with a long and variable lag. One subtlety here is that the variable can refer not just to differences between one recession and another, but also different parts of the economy within the same cycle. And this right here, that means the full force of the Fed hikes, which we have also talked about on the channel before. So the full force and the full impact of the Federal Reserve hikes of 525 basis points since early 2022 won't be felt until the end of this year or early 2024. And when that happens, it will provide a fresh impetus for stocks and housing to turn down. It's premature to say that the economy has weathered the storm because there's a significant lag. And of course, we know that, when it comes to market memory, it is very, very short term. We just look at, stocks are up in 2023. Economy is holding up really well. Manufacturing's up, construction's up, economy is growing. It's going to be fine. Soft landing all the way. We're fine. The market and the economy can weather these higher interest rates. But that obviously, is somewhat coming in with a lag effect, right? So a downturn is hiding in plain sight in the forecast, is what Bloomberg also reported. So against the backdrop of this monetary squeeze, it's a little wonder that some indicators are already flashing warning signs. And Bloomberg Economics took a closer look at these measures that are specifically important for the eminent academics. So again, National Bureau of Economic Research is the typical agency that weights several months after the recession actually began. But NBR's slump dating committee identifies six indicators that weigh heavily into their decision. And they're also expecting that Bloomberg Economics built a model to mimic the committee's decision-making process in real time, and it works fairly well to match these past calls. What it says about the future, there's a better than even chance that sometime next year, NBER will declare the U.S. is in a recession, or it began in the closing months of 2023. So that's the expectation, that it's sometime in 2024, NBER is going to mention that the U.S. is in a recession that began in end of 2023. And finally, going over to oil spike yield curve, we've talked about this. Oil prices have been going higher. That's going to put upward pressure on inflation. Yield curve has been pushing higher as well. Again, we are sitting at 4.6, 4.7% for the 10-year treasuries. And then finally, we got delinquency rates that are low that are also begun to climb. And the forecast is for us to see credit card and more specifically auto loans. Now, these are the starting points because mortgages, those are the last ones to go. Student loans are just getting started, so it's possible that they also start trending higher. But auto loans and credit card loans are expected to hit almost 8%, 9% delinquency rates, which is high, right? 30 days plus overdue. And banks are also tightening their credit conditions, lending standards, and that's also always happened prior to a recession. You can go back to 1980s. This right here is a good indicator of pretty much suggesting that every time the banks have tightened their lending standards, this right here a couple times, they've done that during a recession or in and around a recession. It happened 4 out of 4 times in the past. And this right here, once again, we're at over 40% at the moment for both large, medium-sized firms and to small firms as well. So that's where we are. And look, my understanding is that we haven't been at such high interest rates in over 16 years. We're dealing with the highest amount of debt when it comes to the U.S. at over $33 trillion. Interest on that debt has also increased. Record credit cards, record auto loans, record mortgages. The cost of borrowing in itself is extremely high. So this is a big experiment, right? I mean, nobody really knows at the end of the day what's going to be the end game. But looking at, of course, historical statistics and measures and indicators, I think it's very naive to assume that the economy is going to be fine considering how high interest rates are. And we haven't seen these levels in over 16 years, and the situation from a fiscal standpoint has only gotten worse. So when you combine those pieces together, it's, like I said, it's a little bit more naive to expect that the economy is going to be fine. Unemployment is going to be low. As I mentioned in my previous videos, there is a very high probability that if interest rates stay higher for longer, and it's really important for us to understand higher for longer is the important keyword here. I'm not saying that things can start to break away if the Federal Reserve starts cutting rates and they bring it down to 2%, right? Because the economy wouldn't have had the time to stay at these higher levels for a very long time, right? If you get up to 5.5%, and then immediately gets dropped down to 1%, that's fine. I mean, the economy is not going to have enough time to kind of go through that higher interest rates. But if we stay at 5+%, 6%, possibly even higher for long periods, and I'm talking 6 months, 12 months, several quarters, that's where the pain comes in. That's where the pressure starts to build up, because cost of borrowing can only go on for so long until excess savings start to deplete. So there was another chart that I didn't go over that goes over the excess savings that have depleted significantly. So this right here, U.S. excess savings depleted for bottom 80% of households, and they're now literally in negative territory, right? So household incomes, 0 to 40%, we got 40 to 80%, 80% plus. Everything has been trending lower since the beginning of 2022. So that's exactly why there's not a lot of time left for economy to continue strong with higher interest rates. Now, all of that is going to tie well to the market, because even if you do see sellouts, right? Even if you do see, let's say, a recession, depending on the severity of that recession, that's going to represent deals. So I don't want you guys to, end up watching this video and feel like, okay, this is like a really, really bad situation or bad scenario that we're in. No, it's going to create opportunities. It's going to create a lot of deals, a lot of buying opportunities, in my opinion, for us to dollar cost average into, whether it's the indexes, ETFs, stocks, real estate, whatever it is. Gotta have some dry powder, gotta have a watch list ready, gotta have some fair values ready, gotta have a shopping list ready, gotta be aware of those deals so you can take advantage of it. So don't think of it as like this being really brutal. Yes, from an economic standpoint, it is potentially going to be, but that's also going to create opportunities. And one of the best times to be investing is when you feel the worst, right? that's usually the best times to be investing in the markets, is when you're actually not feeling like doing it, because you feel like, okay, there's more pain and there's more downside and there's more sellouts. And statistically speaking, that's usually, psychologically, it's one of the best times to be looking into deals and looking at opportunities. So hope you guys enjoyed this video. Just wanted to break this down for you. And as always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. And let me know in the comment section below, what is your thoughts? What is your opinion? What's your perspective on the recession from the US? Do you believe that we're already in one? Do you think we're going to see one? Or do you think that we're going to avoid one? So let me know in the comment section below. As always, happy investing. I'll see you all in the next video.